Welcome back to Smart Money with Diana. Today, we're wrapping up our financial math series with one of the most practical topics, how to make investment decisions using cash flow. This is where all the concepts we've learned, like NPV, IRR, and time value of money, come together to help you make smart choices in real life. Example: imagine you have $20,000 to invest, and you're choosing between opening a small coffee shop or starting an online store. Each project has different cash inflows and costs over time. Which one should you choose? That's exactly what you'll know by the end of this video. What is cash flow in investment decisions? Cash flow simply means the money going in and out of your project or investment over time. Inflows are the money you receive, like sales revenue, while outflows are the money you spend, like salaries, rent, or equipment. Types of cash flow in projects. Initial cash flow: the money you spend at the start, then buying equipment, licenses, etc. Operating cash flow: the money you earn minus costs during the life of the project. Terminal cash flow: the money from selling equipment or receiving final payments at the end. Simple example: initial buy coffee machine equals negative $5,000. Operating profit from sales each year equals plus $3,000. Terminal sell coffee machine after 3 years equals plus $1,000. Now let's quickly review the 3 main tools for evaluating investments with their formulas. Net present value, NPV. NPV equals sum of cash flows of the period minus initial investment, where CFT equals cash flows in period, TR equals discount rate, interest rate or cost of capital, C0 equals initial investment. When to use: when you want to know the total value your investment adds in today's money. If NPV is made the zero, the project is profitable. Best for long-term investments with varying cash flows. Internal rate of return, IRR. IRR is the rate R that makes the NPV equals zero. Formula: 0 equals sum of cash flows of the period minus initial investment. When to use: when you want to compare the return rate to your minimum acceptable rate, cost of capital. Except if IRR is made from required rate of return. Payback period. Payback equals the time it takes to recover your initial investment from net cash inflows. Formula: when cash flows are constant. Payback equals initial investment divided by annual cash inflow. When to use: when liquidity is important, you want your money back quickly. Useful for quick risk assessments. Limitation: ignores cash flows after the payback period. Often you shouldn't rely on just one method. For example, NPV tells you value, IRR gives you the rate of return, and payback tells you how fast you get your money back. Using 2 or more methods together gives you a more complete picture.
Step-by-step cash flow analysis. Example project: you invest $10,000 in a small bakery. Projected net cash inflows: Year 1, $3,000. Year 2, $4,000. Year 3, $5,000 discount rate, 8%. Step 1. List cash flows by year as shown on the dashboard. Step 2. Calculate NPV using the formula. Step 3. Find IRR using financial calculator or Excel. Step 4. Calculate payback. Step 2. Present value year by year. We use this formula, PVT equals CFT, divided by 1 plus R to the power of T year 0, negative 10,000 year 1, 2,777.78 year 2, 3,429.36 year 3, 3,969.16 sum of PVs of inflows, 2,777.78 plus 3,429.36 plus 3,969.16 equals 10,176.30. NPV equals 10,000 plus 10,000. 176.30 NPV equals $176.30. Step 3, IRR make NPV equals 0. We use DIRR formula. We solve by trial approximation or Excel. At 8%, NPV is approximately plus 176 NPV. At 9%, NPV is approximately minus 20 NPV. Linear interpolation, IRR equals 8% plus 176 divided by 196 times 1%. More precisely, IRR equals 8.896% D. Payback, simple undiscounted, cumulative end, year 1, minus 10,000 plus 3,000 equals minus 7,000 end. Y2 minus 7,000 plus 4,000 equals minus 3,000 end Y. 3 minus 3,000 plus 5,000 equals plus 2,000. Fraction of year 3 to recover remaining 3,000. 3,000 divided by 5,000 equals 0.6. Payback equals 2.6 years. Real example. Choosing between two projects. Project A, lower investment, faster payback. Project B, higher investment, bigger returns later. Project A, cash flow, year 0, minus 15,000. Year 1, 6,000 year 2. 7,000 year 3. 7,000 discount rate R equals 8%. Project A CFs, minus 15,000 plus 6,000 plus 7,000 plus 7,000. Years, 0 to 3A. PVS at 8%. PV0 equals negative 15,000 PV. 1 equals 6,000, divided by 1.08 equals 5,000. 555.56 PV2 equals 7,000. Divided by 1.082 equals 7,000. Divided by 1.1664 equals 6,000. 1.37 PV, 3 equals 7,000. Divided by 1.083 equals 7,000 divided by 1.25. 9712 equals 5.556. NPVA, negative 15,000 plus 5,500. 55.56 plus 6,000, 1.37 plus 5,500. 56.83 NPVA equals plus 2,113.75B. IRRA, try a couple of rates. NPV versus R. At 15%, NPV approximately equals plus 113. At 16%, NPV approximately negative 141 interpolate. IRR equals 15% plus open parenthesis. 113 divided by 113 plus 141, close parenthesis times 1%. IRR equals 15.44% C. Payback. A simple end, Y1, negative 9,000 and Y2, negative 2,000 and Y. 3 plus 5,000 fraction in Y. 3 2,000 7,000 equals 0.28. 572 payback equals 2.29 years. Project B cash flow. Year 0 minus 25,000. Year 1, 9,000 year 2, 10,000 year. 3 to 15,000 year, 4 to 15,000. Discount rate R equals 8%. Project B CFs minus 25,000 plus 9,000 plus 10,000 plus 15,000 plus 15,000 years, 0 to 4. A, PVS at 8%. PV0 equals negative 25,000. PV1 equals 9,000 divided by 1.08. 8,333.33. PV2 equals 10,000 divided by 1.08. 2 equals 10,000 divided by 1.1664 equals 8,573.39. PV3 equals 15,000 divided by 1.0. 83 equals 15,000 divided by 1.259712 equals 11,907.48. PV4 equals 15,000 divided by 1.084 equals 15,000 divided by 1.3. 60489 equals 11,025.45. Sum inflows PV approximately 8,333.33 plus 8,573.39 plus 11,907.48 plus 11,025.45 inflows PV equals 39,839.658. NPVB equals negative 25,000 plus 39,000. 839.65 equals plus 14,000. 839.65B IRR B check rates. At 25%, NPV approximately plus 2,424. At 30%, NPV approximately minus 80. Interpolate. IRR equals 25%. Plus 2,424 divided by 2,424 plus 80. Times 5%. IRR equals 29.83% C. Payback. B. Simple cumulative. End. Y1. Minus 16,000 end Y2. Minus 6,000 end Y3. Plus 9,000 fraction in Y3. 6,000 / 15,000 equals 0.4 payback approximately equals 2.4 years. Decision. NPV, 8%. Project B wins. IRR. Project B still wins. Payback. Project A is faster. If liquidity is critical, choose A. If long-term profit is priority, choose B. What to do when methods disagree. If liquidity, recover fast, matters, favor shorter payback. Project A. If value return matters, favor higher NPV IRR. Project B clearly wins here. In practice, use at least two metrics, NPV plus IRR. Add payback if timing risk is critical.
Common mistakes. 1. Forgetting to include maintenance or hidden costs. 2. Using unrealistically high sales projections. 3. Ignoring inflation. 4. Hiling on only one metric. Cash flow analysis isn't just for big corporations. It works for personal investments, small businesses, and even deciding between rental properties. Combine methods like NPV, IRR, and payback to make smarter decisions. If you enjoyed this series, check out the full playlist and download our free financial math cheat sheet. And don't forget to like, subscribe, and share this video.